The stock market just touched a brand new all-time high, and for one particular person, it didn't register as anything at all. Dale glanced at his phone that morning and saw the headline, the S&P 500 closing at a record, sitting right above a text message from his landlord announcing a rent increase. He turned the phone screen down and went back to his cereal. 3 floors above him, in the same building, Priya saw the exact same headline. She didn't look away from it. Instead, she watched a number in her brokerage app climb by more than Dale earns in an entire year, took a sip of coffee, and carried on with her day. Same city. Same building. Same words on the same screen. 2 completely different realities. I'm Root, and today we're digging into the question that quietly drives everyone up the wall. If everything around us feels like it's falling apart, if prices keep climbing and owning a home feels impossible, why does the stock market keep celebrating like nothing is wrong? This isn't a story about the market being broken. It's a story about what that number is actually measuring, and why it was never designed to measure you. Let's start with the thing almost nobody says plainly: the stock market is not the economy. You've probably heard that line thrown around on television, usually by someone who never bothers to explain what it actually means. So let's actually explain it. Picture the stock market as a massive scoreboard hanging above a stadium. Your gut instinct is to assume that scoreboard tracks how everyone in the crowd is doing. It doesn't. It tracks how a small handful of players down on the field are performing. Most of us are sitting in the stands, and that scoreboard lighting up doesn't mean our seats got comfier or our snacks got cheaper. It simply means the players we came to watch are having a great night. Once that image clicks, the whole paradox stops feeling like a paradox. Here's the second big piece: the stock market doesn't care about today. It never has. The economy, jobs, wages, egg prices, your rising rent, describes what's happening right now. The stock market is a bet on what a group of massive companies will be earning years down the road. It's less of a thermometer and more of a fortune teller, and a fairly overconfident one at that. So when you feel financially squeezed today and the market rockets to a new peak on that same day, those two things aren't even talking about the same time frame. You're living year Tuesday. The market is pricing in the year 2030, and it's not even pricing in your version of 2030. About 28% of the revenue earned by S&P 500 companies comes from outside the United States entirely. For the biggest tech firms specifically, it's over half. So that board you keep nervously checking, the one you assume mirrors your town and your job and your local store, is in large part tracking something else completely: how many iPhones Apple moves in Europe, how many chips shipped to data centers on the far side of the globe. Your rough Tuesday and a record-breaking SP were never contradicting each other. They were never even describing the same universe. And if you need proof that the market can wander completely away from your actual life, look at early 2020. Unemployment spiked to levels not seen since the Great Depression. People were legitimately frightened. The market dropped for about a month, then turned around and sprinted to brand new record highs while millions of people were still jobless. Record highs and unemployment lines, holding hands, at the very same moment. It's happened before, and it will happen again, because these were never the same measurement to begin with. Now, if I told you the market hit a new high, you'd probably picture all 500 companies rising together, a rising tide lifting every boat. That's not what's actually happening either. Let's look at where this party is really being thrown, because the room is much smaller than you'd guess. There's a cluster of companies people now call the Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Alphabet, Google's parent company, Meta, Facebook's parent company, and Tesla. 7 companies out of 500. Right now those 7 names alone make up roughly 32% of the entire index. Widen that to the 10 biggest companies, and you're looking at more than 40% of the index resting on just 10 stocks. The last time concentration got anywhere close to this extreme was the dot-com bubble back in 2000, and we've now sailed well past that mark. What that actually means is that the S&P 500 is wearing a costume. It's dressed up as 500 diversified American businesses, but underneath, it behaves like roughly 10 enormous, very similar tech companies holding hands. In 2025 alone, one single company, Nvidia, was responsible for around 15% of the entire index's gain for the year. One company out of 500 drove roughly a sixth of everyone's returns. Here's the part that should genuinely reshape how you look at your own account. Say you put $10,000 into a standard SP 500 index fund, the exact move every finance person, myself included, tells you to make. You'd assume you just bought 500 companies, nicely spread out. In reality, you put about $3,200 into those 7 giants alone, then scattered the remaining $6,800 across the other 493 companies. By the time you reach the medium-sized businesses near the bottom of that list, you own literally a few dollars worth of each. The 500th company gets pennies. Actual pennies. You didn't buy a diversified basket of 500 businesses. You bought 7 massive bets wrapped in a trench coat labeled diversification. Okay, so the board measures the future, it measures global giants, and really it's mostly tracking about 10 of them. But we still haven't cracked the piece that explains why Dale feels absolutely nothing while Priya got richer just by glancing at a headline. This is the part that matters most, so stick with me. Ask yourself something deceptively simple: when the market hits a record high, who actually pockets the money? Because a record high isn't free cash falling from the sky onto the whole country. The headlines make it sound like a piñata just burst open over America. It didn't. It's the value of stocks rising, which only benefits you if you already own the stocks. And here's the fact that quietly explains almost everything you're feeling: the wealthiest 1% of American households own roughly half of all stock in the entire country. The top 1% alone hold more stock than the bottom 90% of the country combined. Widen it to the top 10% of households, and they own somewhere around 90% of all existing stock, which leaves the bottom half of the country, half of all people, owning roughly 1% of the market between all of them. So when that headline shouts record high and the anchor sounds thrilled about it, understand what's actually occurring. Those gains are landing almost entirely in accounts that already belong to people who were already wealthy. The party isn't locking you out on purpose, it's just happening inside houses you were never handed a key to. And before anyone types, "But Root, I have a 401k," yes, plenty of people own a small slice. But look at the gap between a small slice and a massive one. The typical American with a retirement account holds around $44,000 in it. That's the median, the person standing right in the middle, and it's the honest figure, not the average, which a handful of enormous accounts drag way upward. So when the market has a huge year and jumps 20%, that middle-of-the-pack person gains maybe $8,000 to $9,000 on paper. Real money, genuinely, but it doesn't buy a house, and it doesn't fix a rough month. Meanwhile, a household holding $2 million in stock gains $400,000 in that exact same 20% move. Same market, same day, same percentage. One person got a mildly nice number on a screen. The other person just out-earned a full decade of the first person's salary without lifting a finger. That, right there, is Priya and Dale. That was always Priya and Dale. So maybe you're thinking, fine, the wealthy own most of it, but why does it keep climbing, especially when things feel this rough? Shouldn't all this fear and gloom drag it down? You'd think so. But the market has a couple of engines bolted onto it that push it upward almost automatically, and once you notice them, you can't unsee them. Engine 1, your paycheck. Every 2 weeks, tens of millions of people have money automatically pulled from their paychecks and dumped straight into index funds inside their 401k. That money buys stock no matter the price. Nobody's checking whether the market looks expensive that day. Nobody's reading the headlines first and deciding to wait. It's a buyer that shows up every single payday, cash in hand, with zero opinions. Index funds now hold more than half of all the money sitting in American mutual and index funds combined. That's a mountain of automatic, price-blind buying that never stops, like a robot vacuum that only knows how to purchase stock. The building could be on fire, and it would still be quietly bumping into the walls, buying more. And here's the maddening part, that autopilot doesn't care that Dale is behind on his bills. It pulls his $40 this Friday whether he thought about the market for even a second, the same way it pulls Priya's contribution. The difference is Priya already has 100 times more riding on it. The same rising tide lifts her yacht and Dale's little dinghy by very different amounts. Engine 2, companies buying back their own stock. Over the past year alone, SP 500 companies spent more than $1 trillion, a record, repurchasing their own shares. When a company buys back its own stock, there are fewer remaining slices of the pie, so each leftover slice becomes worth a bit more, and the price drifts upward. It's a company voting for itself with its own wallet. Between the payday autopilot and $1 trillion in buybacks, you get relentless, almost mechanical upward pressure that has very little to do with whether ordinary people are actually doing fine. There used to be a third force too, something people nicknamed Tina. There is no alternative. For over a decade, interest rates sat basically at zero, so savings accounts and bonds paid you almost nothing, meaning there was nowhere else to park your money except stocks. Cash flooded in simply because it had no other home. That excuse is mostly dead now, since bonds actually pay something again, and yet the money has largely stayed in stocks out of pure habit and momentum. Which tells you something a little unsettling. At this point, the machine keeps buying not always because it's a great deal, but because it's built to keep buying. And that's the entire engine behind the frustration, isn't it? Because at the exact same moment all this money is automatically shoving the scoreboard higher, real human beings are looking around thinking, wait, why does everything feel so much worse? And they are not imagining it. Consumer sentiment, essentially a giant national survey of how people feel about the economy, recently hit some of the lowest readings ever recorded. Lower than the 2008 financial crisis. Lower than the darkest lockdown days of the pandemic. People don't feel bad because they're confused or ungrateful. They feel bad because of the receipts. Prices are up roughly 25% since the start of 2020. That's not a typo, and it doesn't reset once inflation cools down. The number is cumulative. The money in your pocket buys about a quarter less than it did a few years back, and that's permanent, unless your paycheck grew to match it. For a whole lot of people, it simply didn't. It caught up to flat, and flat, after all of that, doesn't feel like a celebration. Then there's the housing scoreboard, the one people actually feel in their chest. The median home now costs roughly 5 times the median household income. Back in the 1990s, that ratio was closer to 3. The typical monthly house payment has roughly doubled since 2020. And the share of buyers purchasing their very first home just dropped to the lowest level ever recorded, the lowest since tracking began back in 1981. The typical first-time buyer is now 40 years old. So when someone cheerfully insists the economy is booming because the market hit a record, and your entire lived experience says you can't afford the exact house your parents bought at 28, you're not wrong, and you're not bad with money. You're just reading a completely different scoreboard than the one on TV. Yours measures your life. Theirs measures their assets. If this kind of breakdown scratches an itch for you, if you'd rather understand the machine than just be vaguely angry at it, that's exactly why I run a community where I break down how I turn research like this into a faceless YouTube channel that actually grows the research, the scripting, the whole system, step by step. No gatekeeping, no upsell. If you've ever quietly thought about building something like this yourself, the link is in the description. Come hang out. Alright, back to it, because I promised you both sides, and the honest version of this story genuinely has two. Everything I said so far might sound like I'm winding up to scream it's a bubble, sell everything, run for the hills. I'm not, because that would be lazy and dishonest, and the real answer is actually more uncomfortable than a crash warning. The people paying these prices aren't fools, so let's genuinely steelman them. The bull case is legitimately strong. These giant companies at the top aren't the empty hype stocks from the dot-com era, the ones with a slick website, a dream, and zero profit. These companies print real money, almost absurd amounts of it, the kind where billion stops being impressive and starts being a rounding error. Profit margins for the S&P 500 are near the highest levels ever recorded. And those top 10 companies don't just take up 40% of the index's size, they generate a genuinely massive share of its actual earnings too. So part of that scary concentration is, weirdly, earned. If a small handful of companies are quietly running the digital infrastructure of the entire planet while printing record profits, then maybe paying a premium for them isn't completely insane. That's the bull case, and it honestly deserves respect. But now the bear case, and it's every bit as real. By nearly every long-term measure available, stocks are about as expensive right now as they've ever been in history. There's a well-known valuation tool called the CAPE ratio, and right now it's sitting at its second highest reading in roughly 145 years. The only time it was ever higher was at the peak of the dot-com bubble, right before the whole thing collapsed. There's another gauge Warren Buffett is famously fond of, one that compares the size of the entire stock market to the size of the entire economy, and it's currently sitting at an all-time record high. None of that guarantees a crash tomorrow. Expensive markets can stay expensive for years, and anyone claiming they know the exact timing is trying to sell you something. But it does suggest two boring, unglamorous truths. Future returns starting from these prices are likely to be lower than the wild run of the past few years, and if sentiment ever does shift, having 40% of the index balanced on 10 very similar stocks is an awful lot of eggs in one very shiny basket. So let's put the whole answer in a single breath, in case you drifted off somewhere around the robot vacuum. The market measures the future, not your right now. It measures roughly 10 giant global companies, not 500. And it measures the people who own it, not the people who work for a living. Future, not now. Giants, not 500. Owners, not you. So let's pull this all the way back to Dale, to Priya, and to you, and get to the part you actually came here for: what any of this means for a regular person who isn't running a hedge fund. First, record highs by themselves are not a warning siren. This part really matters, because doom is addictive, and I refuse to feed it. The market has hit roughly 17 new record highs a year on average going all the way back to 1950. New highs are the normal, healthy, honestly kind of boring default state of a market that grows over decades. So if you're steadily investing every month for the long haul, a record high is not your cue to panic and pull everything out. Historically, that exact move is how people lock in the very loss they were afraid of in the first place. But second, and this is the part cheerful headlines always skip, you're allowed to hold two ideas in your head at once. You can keep calmly investing, and also refuse to believe the last 3 years are some kind of binding promise about the next 3. You can own the index and still fully understand that underneath the costume, it's really the same handful of giants doing most of the heavy lifting. And you can quietly choose to diversify a bit more, a little international exposure, some bonds that finally pay you something again, maybe an equal weighted slice of all 500 companies instead of one giant lopsided bet on 7. That's not fear, that's simply refusing to mistake a scoreboard for a guarantee. Because here's what I genuinely want you to walk away with: the stock market hitting a record high was never a statement about how you specifically are doing. It was never measuring your rent, your raise, your grocery bill, or your shot at owning a home. It's a scoreboard for one particular game, played mostly by people who already own the field. And the moment you truly understand that, the frustration loosens its grip a little, because you finally stop waiting for a number on a screen to rescue a life it was never built to measure. Dale is still down in that building, still doing his grim little math on bills. Priya is still 3 floors up, still watching her number quietly climb. And the honest, slightly uncomfortable truth is that the same green arrow means two completely different things to the two of them, and it always will, right up until the day Dale owns a piece of that field himself. Because that's the actual game. It was never about timing the board or waiting for it to rescue you. It's about slowly, boringly, unglamorously buying your own way onto the field, one automatic paycheck at a time, until one day a record high finally means something for you too. So here's the question I'll leave you with, and it's genuinely worth sitting with: if that record high was never measuring you in the first place, then what would it actually take to get you into the game it is measuring? Sit with that one. And if you want to start figuring it out alongside other people doing exactly that, you already know where to find me. I'll see you in the next one.